In this class, I am going to solve the problem 11. In the previous class, I have explained in detail about the problem 11. So let me solve one by one. First, house 1 or first property, and it is used by SSC for own profession. So therefore it is not applicable under the head income from house property. Now the second house. The second house is a let out property. It has been let out on a monthly rent of rupees 1250 and vacant for 1 month. So we will assess it as per the provisions of let out property. First, municipal value, it's a 15,000, and fair rental value 18,000, standard rental value 16,000. The municipal values are given in the beginning. The second house municipal value is 15,000, and fair rent is 18,000 and standard rent is 16,000. So next, expected rental value. Expected rental value is 16,000. First highest, municipal value or fair rental value, whichever is highest. The highest is 18,000, 18,000 or 16,000, whichever is a lowest. So lowest is a 16,000. So 16,000 is a expected rental value. Next is a rent received. The rent of the second house. Rent of second house is 1,250 per month, and it has been let out for a total let out duration is a 11 month. 11 month is a total let out duration because there is a 1 month vacancy. So out of 12 months, 1 month vacancy. So total let out duration of second house is a 11 months. So rent received for 11 months is a 13,750. 1,250 into 11 months, and 1 month is a vacancy. So after considering the vacancy and unrealized rent is not there. So actual rent received for let out duration is 13,750. Next comes gross annual value. The gross annual value is here. The second provision of gross annual value is applicable because of a vacancy period. So whenever vacancy period is given, then rent received is equal to gross annual value, or gross annual value equal to rent received if there is a vacancy period or unrealized rent. So in this house there is a 1 month vacancy. So therefore rent received itself is the gross annual value. Next, municipal tax. The municipal tax is a 10% of annual municipal value. So municipal value of the first house is a 15,000. 15,000 into 10%, it is 1,500, and which has been paid in the previous year. So gross annual value less municipal tax, the balance amount is called as a net annual value. So net annual value of the second house is a 12,250. 13,750 minus 1,500. Next, deduction under section 24. The first one is a standard deduction and second one is a interest on loan, which is a common for all let out property. So first, standard deduction, it is 30% on net annual value. So here net annual value is 12,250 into 30%. So SSC is going to get 3,675 as a standard deduction. The interest on loan is a nil because no loan details provided, no information regarding the loan. So therefore interest on loan is considered as a nil. So income in case of second house property is a 8,575. Net annual value 12,250 less standard deduction 3,675. The balance 8,575 is the income of second house property. So this is the solution for the second house. So now I am going to assess third house. So third house is a self-occupied property as per the given information in the problem. So SSC used the third house for residential purpose. So it is a self-occupied property. So we will assess it as per the provisions of a self-occupied property. It begins with the net annual value. Net annual value is a nil and it is a fixed for all self-occupied property. So it starts with the net annual value nil, then deduction under section 24, that is interest on loan, only interest on loan deduction comes under section 24. For self-occupied property, only one deduction. So here in case of third house, SSC borrowed rupees 5 lakh for the construction of the third house, and which began on, the loan was borrowed on 1st August 2015 at 12% per annum. The house was completed on 1st June 2018. So these are the details which are given related to the third house, and with the help of these we have to calculate interest on loan. So we will calculate it, the interest on loan, since there is a loan amount. So there are two parts in case of interest on loan. Whenever the loan amount and other details are given, then you have to calculate interest on loan under two categories. First one is a 1/5 of PCP interest, and second one is a interest on loan in previous year. So we will calculate the first part, 1/5 of PCP interest. The equation for this 1/5 of PCP interest is loan amount into interest into PCP by 12 and multiplied by 1/5. The first we will substitute the values which are given in the problem for the equation. Loan amount is a 5 lakh which is given in the problem. Interest, rate of interest is a 12%, that also given in the problem. Next is a PCP, pre-construction period. So that is not given in the problem directly. So we have to calculate with the help of date of loan borrowed and date of construction completed. So before that, what is PCP? PCP means the date on which the loan borrowed and end on 31st March prior to the date of completion of the construction of house property. So that is called as a PCP, and that duration, pre-construction period or pre-construction term, so that we have to calculate, and that begin on the date on which the loan borrowed end on 31st March prior to the date on which the construction completed. So in this problem, the date of loan borrowed is 1st August 2015 and the date of construction completed is on 1st June 2018. So with the help of this, we have to find out the PCP. The PCP means it starts on the date on which loan borrowed, the date of loan borrowed on 1st August 2015, and end, PCP end is 31st March prior to the date on which the construction completed. So in the month of June 2018, the construction completed. So we have to calculate the PCP till March only of that particular year. In the year June 2018, the construction completed. The previous 31st March till March only we have to calculate the interest. So PCP is from 1st August 2015 to 31st March 2018, total 32 months. So that we applied for the equation. So PCP is 32 by 12. Next multiplied by 1/5. It has to be paid in 5 equal annual installment. So then the 1/5 of PCP interest you are going to get 32,000. That is the first part of interest on loan. The second part is interest on loan in previous year. Formula or equation for this is outstanding loan in previous year into rate of interest. It is based on the outstanding loan in the beginning of the previous year. So here the outstanding loan for the beginning of the previous year, that information not provided. If it is not provided, then we have to assume that the entire loan amount is outstanding in the beginning of the previous year. No details regarding outstanding loan. So if there is no information regarding outstanding loan, then we have to assume that the entire loan amount is outstanding in the beginning of the previous year. So here SSC borrowed 5 lakh as a loan for the construction of the house, and 5 lakh itself is outstanding in the beginning of the previous year. So outstanding loan into rate of interest 12%. So total interest on loan for the previous year is 60,000. So that is the second part of interest on loan for the previous year. So 1/5 of PCP interest 32,000, interest on loan in previous year 60,000. So total deduction under section 24 for interest on loan is 92,000. So that is for the second house. So there is a loss of 92,000 in case of third house, not second house. In case of third house, there is a loss of 92,000. Of course, the SSC gets the loss because it is a self-occupied property. So minus 92,000, it's a loss from house property in case of third house. Now I am going to assess fourth house. The fourth house is also let out property. So we will calculate the expected rental value. So expected rental value of fourth house is 25,000 after comparing these all. Next is rent received. The rent received for the fourth house, it has been let out for rupees 3,000 per month. The monthly rent is a 3,000 and there is a 2 months vacancy. So total rent received is for 10 months, or total let out duration is a 10 months. So therefore rent received for the fourth house is a 30,000. So 12 months, out of 12 months, 2 months is a vacancy period. So let out duration is a 10 months. So rent received is a 30,000, no unrealized rent. So rent received for the let out duration is a 30,000. Next is a gross annual value. Gross annual value equal to rent received due to vacancy period. Here vacancy period is given. So there is a vacancy period. So therefore gross annual value is equal to rent received. So that is a 30,000 is a gross annual value. Next is a municipal tax paid. It is a 10% of municipal value. Municipal value is a 25,000 in 10%. So SSC is going to get 2,500 as a municipal tax. Next, net annual value, that is 30,000 minus 2,500, 27,500 is a net annual value. Next comes deduction under section 24. The first one, standard deduction, 30% on net annual value, that is 27,500 into 30%, so 8,250. Interest on loan, so here direct interest amount has been given. The two details are given related to the loan. In the previous year, he paid 20,000 towards principal and 16,000 towards interest on loan. So only the interest on loan is eligible for deduction under section 24, not the principal amount of the loan. So you have to give the deduction only for interest on loan. It has been clearly specified under section 24. Only interest on loan is liable for deduction. So that is a 16,000, not the principal amount. So net annual value less standard deduction, then less interest on loan, the balance amount is 3,250. That is the income of fourth house. Next I am going to assess fifth house. Fifth house again let out property based on the details given. It has been let out. So for a composite rent of rupees 36,000 per annum. So fifth house is also let out property. So expected rental value of fifth house is 29,000 after comparing these values. Next is rent received. So here house was let out for composite rent. That explained that concept of composite rent I have explained in the previous class. The rent which includes the cost of other facilities is called as a composite rent, and while you are calculating rent received from the composite rent, the other rent of other facilities to be deducted which has been paid by the owner. So here composite rent is 36,000 and at the same time SSC pays 6,000 towards electricity and 2,000 as water charges. So whenever there is a composite rent, from that you have to deduct the expenses which has been incurred by the owner. So here total composite rent is 36,000 less 6,000 is a cost of electricity charges which has been paid by the owner, and 2,000 is a cost of water charges again which has been paid by the owner. If it is paid by the tenant is not deductible. Only these applicable whenever the composite rent is given. Composite rent means the rent which includes the cost of other facilities. So cost of other facilities to be deducted, the balance amount is called as a rent of the house property. So actual rent of the house or building is a 28,000. So rent received is a 28,000 for fifth house. and unrealized rent is not there, and no vacancy period. Next, gross annual value. Gross annual value for the fifth house is 29,000. How? Expected rental value or rent received, whichever is the highest. Here no vacancy period, no unrealized rent. So therefore expected rental value or rent received, whichever is a higher, is the gross annual value. So first clause of gross annual value. Next is the municipal tax paid. It is 1,500. 10% of municipal value, it is a 30,000 is a municipal value into 10%. Then 50% of the municipal tax has been paid by the owner and 50% has been paid by the tenant. So we have to take only 50% because SSC paid 50%. So here it has been given the tenant has paid 50% of the municipal tax and remaining 50% has been paid by the owner. So we have to consider the part of which has been paid by the owner. So that is a 50%. 30,000 is the municipal value into 10%. So 10% into 50%. So 1,500. So next is the net annual value, that is 29,000 minus 1,500, balance 27,500 is the net annual value. Next is a deduction under section 24. First is a standard deduction. It is 27,500 into 30%. So you will get 8,250 as a standard deduction. Next, interest on loan. The interest on loan for the previous year is 10,000, which is liable for deduction. That concept again I have explained in the previous class. If you have not watched that video, please go through that particular video regarding interest on loan. So the SSC at the end is going to get the income of rupees 9,250. So this is the grand total of all the 5 houses. First house is used by the SSC for own profession, so therefore it not comes under income from house property. In second house SSC, it's a let out property and there is an income of 8,575. And in third house, self-occupied property, and there is a loss of rupees 92,000. And next fourth house is a let out property, there is an income of 3,250. And fifth house is also let out property, there also SSC received some income, that is 9,250. After considering income and losses of houses, the actually SSC is going to get the loss. In case of out of 5 houses, SSC is going to get the loss of rupees 70,925. So that's all about the solution for problem 11. So I have in detail explained about the problem. If you are not understood, please go through the first video or part 1 of problem 11. Thank you very much.